Gold and silver are not moving in a vacuum anymore. They are moving inside a market that suddenly has a war premium, an oil premium, and an inflation premium all colliding at the same time. That is the real story here. This is not just another routine bounce in metals. This is about what happens when energy shock, geopolitical panic, and collapsing confidence in fiat all begin feeding the same trade. And if that cycle is really starting now, then gold and silver are not expensive yet. They may still be early. Welcome back. Today we need to talk about the chain reaction that could send precious metals violently higher, because what looks like a simple war headline on the surface may actually be the trigger for a much bigger repricing across the entire global system. Here is what happened. War tensions escalated, oil immediately reacted, and the market did what it always does in the first few moments of uncertainty. Traders ran toward safety, governments started preparing statements, analysts rushed to calm everybody down, and financial media treated it like another temporary flare-up. But that may be the wrong read, because when conflict pushes energy prices higher, it does not stay contained in the energy market. It leaks everywhere. It hits transport. It hits manufacturing. It hits food. It hits shipping. It hits consumer expectations. Then it hits central banks. And once that sequence begins, gold and silver stop being optional assets. They become strategic assets. That is the part most people miss. They think metals rally because investors get emotional. They think gold is just fear, silver is just speculation, and once the headlines cool off, the move disappears. But history shows something more dangerous. When war collides with already fragile inflation conditions, metals do not simply spike on panic. They reprice because the underlying monetary environment changes, and that is where this gets serious. Because the world was already unstable before this latest escalation. Debt was already massive. Governments were already running deficits they cannot honestly fund without more borrowing. Central banks were already trapped between weak growth and stubborn price pressure. Consumers were already feeling squeezed. Manufacturing was already slowing in some areas while costs stayed elevated in others. In other words, the system was already stretched. War just adds gasoline to a structure that was already smoking. Now think about oil for a second, because oil is the transmission mechanism that turns conflict into inflation. If war threatens supply routes, refineries, pipelines, tanker traffic, or major producing regions, crude does not need an actual full supply collapse to move sharply higher. It only needs risk. Markets price fear before they price fact. And when oil jumps, it starts acting like a tax on the whole world. Every truck pays more. Every airline pays more. Every factory pays more. Fertilizer costs start rising. Food distribution gets more expensive. Insurance gets more expensive. Shipping rates turn ugly. Households spend more on essentials and less everywhere else. Suddenly, the inflation that policymakers were trying to declare under control starts reappearing in places that are politically impossible to ignore. That is why this matters for gold first. Gold thrives when confidence in monetary stability begins to break. Not collapse completely, just crack. Gold does not wait for total disaster. It moves when investors realize the people in charge have worse options than they admit. And right now, what are those options? If oil-driven inflation rises again, central banks can stay tight and crush growth even harder. Or they can ease into inflation and admit they are willing to let purchasing power burn more slowly than the economy. Neither path is clean. Neither path is bullish for confidence in paper currency. Both paths quietly support gold. But silver is where the story becomes more explosive. Because silver is not just monetary. Silver is monetary stress plus industrial tension at the same time. That means when inflation rises and recession fears rise together, silver can get pulled in two directions for a while. It can look confused. It can shake people out. It can underperform gold briefly. But if the market begins to believe the real destination is renewed monetary debasement, persistent inflation, supply strain, and hard asset demand, silver often does not just follow gold, it starts sprinting. That is why these moments matter so much. Early in the cycle, gold gets respect, silver gets doubt. Then later, once the market realizes the move is not going away, silver starts doing what silver always does in bull phases. It becomes violent, it becomes emotional. It starts catching up in a way that makes previous hesitation look ridiculous. And the setup for that kind of move is not imaginary. Let's break down what most people are still ignoring. The market loves clean narratives. It wants inflation down, rates eventually lower, growth stable, conflict contained, and energy manageable. But what if that neat picture is dead? What if the next phase is not disinflation and soft landing? What if it is rolling inflation pressure mixed with geopolitical fragmentation, supply insecurity, weak real growth, and governments that solve everything with deficits? That combination is not just supportive for metals, it is almost engineered for them. This is why the usual dismissive comments are so dangerous right now. People will say gold already moved. They will say silver is too volatile. They will say war headlines come and go. They will say oil spikes always fade. They will say central banks can control inflation if they really want to. But look deeper. The issue is not whether one specific headline cools off next week. The issue is whether the global economy is entering a period where every new shock lands on top of unresolved structural weakness. If that is true, then each conflict, each oil spike, each inflation surprise, each debt package, each policy pivot becomes cumulative. The pressure does not reset, it compounds. And that compounding effect is what can create an explosive move. Because once investors start believing inflation is no longer a one-time event, but a recurring feature, cash stops feeling safe. Bonds stop feeling safe. Long-duration promises start looking fragile. Suddenly, the thing with no counterparty risk starts looking a lot more attractive. That is gold. And when that psychology spreads from institutions to retail, from sovereign buyers to family offices, from hedgers to speculators, that is when price can detach from the comfortable models people were using a month earlier. Now add silver to that equation. Silver has the same monetary appeal in inflationary fear, but with a smaller market and thinner margins for error. That means flows can hit harder. Price can gap faster. And because silver has spent long periods frustrating people, the positioning can be lighter than many assume. That matters. A market does not need universal belief to explode. Sometimes it needs the exact opposite. It needs skepticism first, then a trigger, then forced recognition. War can be that trigger. Oil can be that trigger. Inflation surprises can be that trigger. And the market may be getting all three. But here is the hidden risk underneath the visible risk. If oil rises because of war, central banks may not be able to respond the way investors expect. A lot of people assume economic weakness automatically means rate cuts and easy money. Maybe. But if inflation is being re-accelerated by energy, cutting too fast becomes politically and financially dangerous. Central banks could end up behind the curve again, not because they want to be careless, but because every choice hurts. Stay tight and growth breaks harder. Ease too early and inflation credibility breaks harder. That is the trap. Gold loves traps like that. Because gold is not a bet on perfection. It is a bet that the monetary authorities are less in control than the public thinks. And in a world of war-driven oil inflation, that bet gets stronger. Then there is the government side of this story. Higher oil means more pressure on households. More pressure on households means more political pressure for subsidies, relief packages, support programs, fiscal expansions, and emergency spending. How do governments pay for that when they are already drowning in debt? More borrowing, more issuance, more refinancing, more strain. So even if the official response looks like helping consumers, the hidden consequence is often more currency dilution over time. That is another quiet tailwind for metals. This is where the bigger implication comes into focus. Gold and silver may not just be reacting to war, they may be front-running the policy response to war. That is a completely different level of bullishness. Because one geopolitical shock can fade. But if that shock creates new deficit spending, renewed inflation fear, reduced confidence in bonds, and a slower path to monetary normalization, then the metal bid stops being temporary. It becomes structural. And once that happens, something else starts to change. The psychology of the market. At first, traders treat metals like a hedge. Then they treat them like momentum. Then they treat pullbacks like gifts. That transition is where the real acceleration happens. The move does not need everyone to agree at once. It just needs enough people to stop asking whether gold and silver should go higher and start asking how high they can go if the macro backdrop keeps deteriorating. That shift can happen fast. Look at how quickly narratives break in modern markets. One week, inflation is cooling. The next week, energy is surging. One week, cuts are guaranteed. The next week, policymakers sound cautious. One week, conflict is contained. The next week, shipping routes are at risk. One week, metals are overbought. The next week, they are being chased by investors who told themselves they would buy on a dip that never came. That is the danger of waiting for clarity in a market like this. By the time the story feels obvious, price has already moved. And let's talk about silver again, because this is where people consistently underestimate the upside. Silver does not need perfect conditions. It needs conditions messy enough to keep gold bid, but not so catastrophic that industrial fear completely overwhelms monetary demand. If the market sees inflation staying sticky, policy credibility weakening, real assets getting re-rated, and gold making a decisive move, silver can turn into the leverage trade hiding in plain sight. That is why silver rallies often look unbelievable in hindsight. While it is happening, the move feels too fast. Before it happens, it feels impossible. In the middle, it feels dangerous. Then months later, everyone says the signals were obvious. The signals may be forming now. War pressure, oil pressure, inflation pressure, monetary pressure, fiscal pressure, confidence pressure. That is not one bullish argument. That is a stack of them. But the market still has another blind spot. It assumes inflation only matters when it shows up cleanly in official prints. That is too late. Gold and silver often move before the lagging data fully confirms the change. They respond to expectations, to forward pressure, to policy constraints, to capital flows. By the time headlines formally declare inflation is re-accelerating, the smarter money may already be positioned. And that creates a nasty problem for anyone still dismissing this move as noise. Because if gold starts breaking out while oil is rising, institutions cannot ignore it for long. They may not love the trade, they may not trust the trade, but they understand what it signals. Gold rising with war and inflation is not just a price move, it is a message. It says the market is beginning to distrust the stability story. It says money is looking for shelter. It says real assets are being repriced against policy uncertainty. Silver, in that environment, becomes the asset people wish they paid attention to earlier. Now, does that mean straight line up? No, absolutely not. Markets never reward that kind of laziness. There will be pullbacks. There will be fake-outs. There will be ugly red days designed to convince everyone the move is over. There will be analysts saying oil cooled by $3, so the inflation scare is done. There will be commentators calling gold crowded and silver irrational. That noise is part of the process. In fact, explosive moves usually need that disbelief to keep building. Because the real fuel is not agreement, it is late recognition. And that recognition can arrive in stages. First the war premium, then the energy premium, then the inflation concern, then the central bank dilemma, then the fiscal response, then the bond stress, then the hard asset bid. Then, suddenly, gold is not just up, it is breaking assumptions, and silver is not just following, it is outperforming in a way that starts looking disorderly. That is when people begin scrambling for explanations that were available the entire time. So what should viewers really be watching here? Watch oil, obviously, but also watch the language from policymakers. Watch whether they start sounding less confident. Watch whether inflation-sensitive sectors begin to wobble. Watch whether real yields stop giving a clean answer. Watch whether gold holds strength even on calmer headline days. Because that would tell you this move is no longer just about immediate conflict. It is about something deeper. And if silver starts holding higher lows while gold leads, pay attention. That can be the market quietly preparing for the next phase. Because once silver believes the gold move is real, the character of the trade changes. Pullbacks become shorter, breakouts become sharper. Sentiment flips from boredom to obsession. And when that flip happens, people who waited for reassurance usually end up buying emotion instead. That is why this title matters so much. Gold and silver could explode as war sends oil and inflation higher. Not because it sounds dramatic, because the mechanism is real. Conflict raises risk. Risk raises oil. Oil raises inflation pressure. Inflation pressure traps policy. Trapped policy weakens confidence. Weak confidence strengthens hard assets. Stronger gold pulls silver into a much more aggressive phase. That chain is not fantasy. It is macro cause and effect. And the most important part is this. The market does not need every link to become permanent. It only needs enough persistence to destroy the complacent assumption that inflation is gone and stability is back. Once that assumption cracks, metals do not need perfect news. They only need continued uncertainty and continued policy confusion. That may be exactly what is ahead. So no, this is not just another scary headline cycle. This could be the kind of environment where gold stops behaving like a side trade and starts behaving like a warning. And when gold becomes a warning, silver often becomes an opportunity wrapped in chaos. The real question is not whether markets are nervous today. The real question is whether this conflict is revealing something much bigger about the next chapter of inflation, energy insecurity, and monetary fragility. If the answer is yes, then the move in metals may be far from over. Because war does not just create fear, it creates repricing. Oil does not just create cost pressure, it creates policy stress. Inflation does not just hurt consumers, it exposes how little room central banks really have. And gold and silver do not wait for the full confession. They move when the first cracks appear. Those cracks may already be here. So keep your eyes on the next oil move. Keep your eyes on the next inflation surprise. Keep your eyes on how gold reacts, especially if headlines briefly calm and it still refuses to break. That is where the message gets loudest. And if silver starts waking up behind it, then this market may be entering the stage that catches almost everyone off guard. Because once the crowd realizes this is not a temporary shock, but a broader reset, gold will not need permission to run, and silver will not ask politely before it moves. If you think the market is underestimating how big this setup could become, let me know in the comments. Do you believe gold leads first and silver follows later? Or do you think both break out together this time? And one more question. If war-driven oil inflation keeps rising, what breaks first? Central bank credibility or consumer demand? Subscribe if you want more high-retention finance breakdowns with the noise stripped out, because this story is moving fast, and the next phase could be the one that changes everything.